Yeah, so one of the things we were talking about was this idea of the volatility of a pendulum. And sometimes these things only swing a little bit. So maybe in that season, if you marked off, here was sort of the maximum swing, and you had a really tight standard deviation, you'd see something like that. And let's see, how do I get the? Where is my color? I don't see it. Maybe is it up here? Well, but then you get a time when the pendulum. So let me say this is like time zero. So time is flowing this way now when it goes like. That first breakout of the control now says, okay, what was that? Does that imply a swing this far out? And is it going to accelerate and then decelerate so I get some kind of... Well, now if I rotate that, 90 degrees, and now I'm putting time this way, and then if I normalize price to this level, and now I only care about the net capture each day, now suddenly I can get my control charts in here, and now I can say this was the the max and the min, or plus or minus one or two standard deviations and whatever. And then when I start getting these big days, what happens when after a period of normality, which we're just going to say whatever the last 30 days was, is the recent normal, and then I have something like plus 1, 1, 2, 3, minus 1, 2, 3. Well, that's what our Bollinger Bands are. With the river is 2/3, and then 1/6, and 1/6, and only like 0.5% of the time. Is it even 0.5% that it gets out beyond Z3s? That's why when those things pinch to some measured alert, like a frog box intraday or 1 ATR on a swing, now suddenly the regime of volatility has gone like this. So we're seeing, what does that pulse look like? Is it like this? So where inside of that expanding or contracting volatility are we? Are we at a natural peak? Where suddenly this expanding volatility becomes and now I'm continuing to try to do the things on this side in declining volatility that were working on this side of expanding volatility, and it no longer is working. That's where we end up having initial success early in the day and then getting chewed up in the crocodile river, and that's why we got to wait for the Z3 pinch or the super pinch. And when the super pinch works is because you had such a tiny little risk box, and then you get this in retrospect, which just looks like the normal periodic change in volatility. So now as we're starting to look at our markets, we can say, what are the amplitudes and what are the frequencies? And how regular is this heartbeat? Does it go in like this, expands and contracts, and then a long period, and then an expansion and contraction, then another one, and then a little one, and then nothing, and then so it's this is the second derivative This is the volatility of volatility. So when you're trading those large instruments like you are with the DAX or the Aussie dollar or the S&P or whatever it is, you got to start understanding how all of this volatility works. So the mental model to have in our mind, and that's where I think the sniper mentality works, is that I want you to think of, you got a pendulum that is swinging here, and that you have something like normal Z2, Z3 out to the max, and you realize that the higher it swings, the more energy, it takes a lot more energy to move it higher because it's fighting against gravity, and then the amount that it actually proceeds in that direction is small. So there's sort of a natural limiting factor that creates the normal volatility of a pendulum, which is why a grandfather clock works, is because that thing they have regularized the swinging of the pendulum as driven by the weights, that each time that weight gets pulled down by gravity, it ticks a gear, one click, which moves the hands with precision. So the precision of a grandfather clock is a function of the reliability of the gravity and the normalized oscillation of a pendulum to drive those hands. So let's just remember, however, that what we're doing is not trading necessarily with the precision of a Swiss watch, although we frame our trades that way. But that thing is sitting on a table. And the table is inside the captain's office in a ship, and that thing is sliding back and forth based on the motion of the ship. So when the table shifts, it creates conditions in which the pendulum is different, and then the breakout of the pendulum from the previous strict normal tells you that something just happened with the shifting of the table. So the volatility of the table can be understood different from the volatility of the pendulum. Oh, and now the ship is being driven by the volatility of the waves. Is it really quiet, or is it in sea state 3? And so now we can say, what is the barometer that tells us something about the condition of the sea state? So the volatility of the ocean is going to affect the volatility of the ship, which affects the volatility of the table, which has friction on the bottom, so it doesn't slide so much, but it does move. And then the volatility of the pendulum. So we have a complex series of nested volatilities, which we try to abstract in a simple way by looking at the 10-period location. That tells you how far in one direction it is swung versus the other. The 30 period and the 150 period. And then, is it at an extreme location? And then also, what are the stats on volatility while it is traversing? Did it come to a little tight little piece? So that volatility now matters compared to, in conjunction of location plus volatility, gives us the simplified sense of a complex nested ecosystem that's pushing price around. It's pushing price around, it's pushing psychology around, and so volatility, appreciating and understanding volatility and what it does to performance and emotions seems to me to be everything. In the shorter your time period, the more tightly you parse the time into little periods, the more important period over period volatility change is. The shorter your time period, the more volatility matters. So we got to understand that about the instruments, and that's the basis of that discussion we had earlier about understanding your R capture versus the daily performance. So if you're capturing what your daily performance was, plus or minus, and then you're comparing that to what the market did, now the difference between what the naive market is doing and then what you're doing with your rule set, that's where you're finding the alpha, the improvement. So my spider sense is that your system is allowing you to catch the swing of the pendulum from peak to peak, and you're trying to catch those pieces in both directions, the traverse from side to side, by being able to identify natural turning points and then just following price in its oscillating pattern. If we do that, then we are simply making bank on volatility and not on trying to predict directionality. And the regularity and change in volatility feels more predictable than price to me. You know, we care about times that are, we want to know about, oh man, that's strange. Giving me an explosive. So in volatility, we want to know the difference between normal. We want to know abnormal large volatility and abnormal quiet volatility. Because the normal volatility is a crapshoot, but when it is already extremely volatile and in play, we can have rules of what to do. And when it's abnormally quiet, we can have rules about what to do. The turning points and continuations of abnormal, that's the two easiest trades I think ever. It's in play and still going, that's momentum. It's in play but it's not going, oh okay, now it's retracement. But it's in play. That's what the volatility tells us. And then the absence of volatility tells us we have that minimum breakout box, and then the move is going to be surprisingly large. And it may be fake one, go two, or it may just go. Those are the two choices, really. Fake one, go two. Okay, you know, infinite. But eventually it has to go, or it's just going to be more of that sideways quiet. You won't lose much money. So that's what I wanted to say about volatility, and get this stuff in the can. Talking about the stacked volatility imagery. So we'll get that cleaned up. A pendulum on a table in a ship on the ocean at sea. In a storm versus quiet. So, all right, boss. We shall see you soon.
Good.
Take good care.
Thanks, Ben.